I anticipate pain in the economy. I anticipate pain in asset classes. And I don't think it's going to be just a 2023 thing. I think it's going to continue on. And sometimes you see a deviation between assets and the economy. Now, you can see the stock market go up when the economy is going down, and you can see the economy go up and the stock market go down. So you can see a deviation between assets and the economy. I think that there's going to be economic pain ahead. To what extent? Well, that's going to depend on what the Federal Reserve Bank does. Unlike previous times, we don't have the same capacity to stimulate and do quantitative easing like before, because before the 2008 crash, before the 2020 pandemic, before the 2001 dot-com burst, we weren't worried about inflation. And so when the Fed did quantitative easing, after each one of these economic slowdowns, it was okay because we didn't have an inflation issue. Well, now, if we see an economic slowdown, the Fed also has to contend with an inflation crisis. And so that could potentially, again, I don't want to speak for what the Fed will do because sometimes they do things that no one expects, but it could make them stimulating and cutting interest rates a lot more difficult.
Hey, what's up, guys? Welcome to the channel here today. We've got a really fantastic episode with a very special guest. We've had him on here on the channel before. As we're just like you, we're out there scouring the internet, definitely looking at YouTube, other content creators to see, if they're like-minded, if they're not like-minded. We've got some that we, have a particular fondness for over the years. One that I particularly like and subscribe to myself is called Minority Mindset. It's a fantastic video platform, a content creator, a gentleman named Jaspreet Singh. We've got him here on the channel today. We're going to be talking about, all things going on in the economy right now, things going on, is it a recession? Is it a recession? What's going on with the Fed? Obviously, everyone's looking at interest rates and mortgage rates right now. We're going to be talking about opportunities in the coming year. We're going to talk about maybe some similarities between this and 2008. And a lot of people that are in the know, smart money investors, know that there's a ton of money to be made right now if you know what you're doing, know where to look, and know how to navigate these troubled times. We're going to be talking about real estate, and then we're going to be talking about the biggest problems that we may be facing here in 2023. So that being said, welcome back to the channel, Jaspreet Singh. Minority Mindset, we'll go ahead and drop a link to his channel below. What the heck is Minority Mindset?
Well, first off, thank you for having me on. Thank you for the introduction and the super kind words. I'm super excited to be here. Minority Mindset is a term that I use which describes a way of thinking. It has nothing to do with the way you look, your ethnicity, or skin color. It's the mindset of thinking differently than the majority of people. And the reason why I came up with this term is because growing up, I had no financial education. My parents immigrated to this country with very little from a state in India called Punjab. And like many Indian immigrants, my parents told me that if I wanted to become successful, I had to study hard in school and become a doctor. It wasn't become a doctor or an engineer, it was become a doctor. And it's kind of funny where it's sometimes very hard to get someone to understand how serious my parents were about me becoming a doctor. But one of the best ways for me to explain this is when I was in 8th grade, about 12 years old, my parents got me a tutor. Now, bear in mind, English is my second language. I was struggling in my English class. I almost failed English in middle school, and my parents got me a tutor. Now, this tutor wasn't for English. My tutor was for the MCAT, the Medical College Admission Test, the test you take between your college years to get into medical school. So they were very serious about me becoming a doctor, and anything that wasn't related to medicine, science, was considered bad and a waste of time. I played football in high school. I had to fight hard to be able to play football because it was, a waste of time. Even when I started in my entrepreneurial ventures when I was in high school, I had to do them all in secret. And my parents didn't really know that I was an entrepreneur until my business was on the news. This is like after college, and we were seeing success. I was running a sock company, and then we got on the local news, and then one of my parents' friends told them that your son was on the news. And my parents thought that I did something bad. And they found out that I was running some company. Then they were like, what the heck? And so, for me, it was always trying to figure it out with no real support, no mentors, no guidance. I didn't have anybody telling me this is how real estate investing works. This is what investing is. This is what passive income is. This is what entrepreneurship is. I had to literally make a ton of mistakes and figure it out and do it while I was going to school. And kind of on the same story, when my parents found out that I wasn't going to be a doctor, they essentially said, well, we'll compromise and you can become an attorney. And that's what I did. I went to law school as a compromise. I never worked a day as an attorney. I run my companies full time. And now my parents are my biggest supporters. And so it's kind of funny how things come full circle. But it's that lack of financial education where, you know, my parents, like many people, didn't understand money. They didn't understand investing. They were never exposed to these things. For them, it was you work, you make money, and you eat. Like that's it. And the whole idea for them was if you can become a doctor, you can make a big salary, which means you can have nice things and be rich. But as you know, like things like you've talked about, when you realize that there's a lot more than just your salary, it's your investments and this level of financial education that we're never taught in school. And that's what really drove me to starting Minority Mindset, the YouTube channel, which is kind of like my hobby, where I make videos talking about money. And then I've been able to very fortunately use the platform Minority Mindset to grow some of my other companies. Briefs Media is my newsletter company. We have free newsletters for investors and business owners. And then Market Insiders, which is like an investing education application.
Fantastic. Well, appreciate the backstory for those of on the channel that aren't familiar with your platform, guys. We'll drop a link to his channel below. I follow it. I subscribe to it. I use a lot of his best practices as well. And what I like about your channel a lot, Jaspreet, is you just really simplify things. You take something that can be, a lot of people can overcomplicate it in their mind, and you just break it down kind of one step at a time and get it on that real granular level that people are able to understand easily. That's how we like to present information here on the channel. You do the same, guys. If you're not on subscriber on his channel, highly recommend you checking that out. So stay tuned to the end of the video today, guys. Jaspreet's an expert in investing, and there's it's a volatile time out here right now. So stick all the way through to the end, and we're going to give some tips on how to navigate these troubled times and how to take advantage of the amazing opportunities that are out there right now if you know where to find them. Let's go ahead and dive into are we in a recession? Are we not in a recession? The definition has changed multiple times. What the heck's going on right now, and how do people plan for it? So it really doesn't matter what you call it, right? We are where we are right now, regardless of what you want to call it from a technical standpoint. How do people plan in the short and the long term for it right now? What are your thoughts on what the heck's going on?
Sure. So there's a lot of answers to this question. I'm going to give like the technical answers. I'll give my opinion, and we'll talk about then what do you do about it. So the word recession creates a lot of anxiety, fear, panic, creates a lot of emotions in people. And the reality is recessions and market crashes create more millionaires than any other time because they create opportunities that some people, what I like to say, people with the minority mindset can see. Now, are we in a recession? Well, this has become a very political answer. Let me just kind of be very honest here. So traditionally, before 2022, the definition of a recession was 2 quarters, aka 6 months of an economic slowdown. We saw that early in 2022, but then we had a lot of people come out and say, essentially, this doesn't count as a recession because it's not bad enough. Essentially, that is temporary. It was kind of like how inflation was transitory in 2021, that the recession is temporary in 2022. Exactly. So then came the 3rd quarter of 2022, and the economy didn't slow, it actually grew. And so now everyone's saying there's no recession, and it's this kind of mixed opinion where some people are saying we're going to enter a recession in 2022 and it's going to be bad. Some people are saying we're going to enter a recession in 2022 and it's going to be very mild. And then you have people saying we're not entering a recession in 2020. Sorry, I'm talking about 2023, and we're not entering a recession in 2023. And so a lot of opinions out there. Now, are we in a recession or not? Well, by definition, okay, just the traditional definition, we're focusing on the technical side. You have to have this organization, the National Bureau of Economic Research. They come out and then they declare we are in a recession. Has that happened? No. But what's interesting is when a recession does get declared, and we're talking about generally speaking, if and when a recession does get declared, they backdate the recession to when the recession started, meaning to when the economy started to slow down. Now, for all intents and purposes, most regular people are already facing a recession. Most regular people are struggling financially. Not everybody, but most regular people haven't seen a 20 to 25% pay raise over the last couple of years, while your cost of living has gone up by many times more than 20 to 25%. They say the inflation level is, the CPI is around 8%. Well, that CPI, that inflation level that is reported, is massaged. And, a lot of people like to say that, but no, you really have to understand the data. I don't like to just say things, but there's a lot of the way that CPI is measured has changed over the years. And the reason why it's changed is to kind of alter the way the data is presented. So what does that mean? Well, for example, one of the biggest pieces of CPI is inflation, which is for regular people. Well, one of the biggest factors in this consumer inflation number is housing costs. But when they determine how much housing costs have inflated, they don't look at home prices and how much they inflated. They don't look at rental prices and how much they inflated. They look at something called OER, owner's equivalent rent. And you might say, what's that? Well, essentially, what you do when it comes to owner's equivalent rent is you survey homeowners and you ask them, if you were to rent your home out, how much would you rent it for? And based off of those numbers, they then say that this is our housing inflation numbers based off of how much people would rent their home out for more now than before. And if you look at like the 2022 housing or CPI numbers, and you look into the housing costs, it says the housing costs have gone up by around 5% or so. And if you look around you, most people, if not the vast majority of people, haven't seen the housing costs grow by 5%. They've seen it grow by double digits, 10, 20%. And this is one of the largest factors in our CPI data. So this is what I mean by, that CPI number that many people see reported isn't the real inflation that many people feel. Many people's rents have gone up by more than 10% over the last 2 years. Many people's home prices have gone up by more than 10%. I mean, housing affordability is at some of the lowest levels we've ever seen because home prices have gone up so much while interest rates have gone up so much. So for the vast majority of people, for most people, I should say, they're already feeling the impacts of an economic slowdown. Now, when does a recession actually happen? Well, a recession actually happens when we talk about when does the pain be felt everywhere, when you see the big problems. Well, that's when people run out of money. And right now, people are still spending. They have the ability to spend. Why? Because, well, we have the ability to go into debt thanks to credit. And, as unfortunate as it is, this is the way the system works, that we have our economic factors. The economy runs on spending. The more somebody can spend, the more money I spend at Chipotle, the more money Chipotle makes, right? And so if I don't have any money in my bank to go buy anything from Chipotle, that doesn't mean I can't buy anything from Chipotle because I still got my credit cards. And so I can go to Chipotle and swipe my credit card, and Chipotle is still making money and the economy can continue to grow. And what we're seeing happen right now is there's still excess savings out there from the pandemic stimulus, but it's dwindling. However, credit card debt is also rising at some of the fastest rates we've ever seen. So spending is still there, but what is that spending? People are going into debt to be able to afford many times just their basic necessities. And so, there's a lot of different factors that play here, from housing, which is one of the most interest rate sensitive sectors, because in housing, when interest rates go up, you immediately as a home buyer feel the pinch, because when you think you're buying a home for 5%, but then you get to the closing table and find out it's a 7% mortgage, that's a huge difference in your payments. So housing is very sensitive to that. However, we haven't seen a huge hit to housing prices because sellers don't have that motivation to sell. Sellers are saying, well, I don't want to sell my home for a discount, so I'll just keep my home on the market for a little bit longer. What would change the housing market? Motivation. What would cause sellers to be motivated? Financial distress. If somebody lost their job, now you become a much more motivated seller. Well, what would cause people to lose their jobs? An economic slowdown. What would cause an economic slowdown? people not being able to spend. So you can start to see how everything gets tied in together, but there's a lot of different factors at play. Interest rates have a big contributing factor to the broader health of the economy. The question is now, what is going to happen with interest rates? The Federal Reserve Bank says that they're going to continue raising interest rates through 2022. In December, they want to raise it again, and then continue raising in 2023 and not cut at all. Now, that's what they say. That doesn't mean that's what they're going to do. But if they stick with that to bring inflation down, that's going to cause pain. That's going to cause pain in the sense that people will not be able to spend it the way they could before. It's also going to cause pain to corporations, because now corporations have loaded up on tons of debt in 2021 and early part of 2022. And what did they do with that debt? Well, we saw a record amount of corporate buybacks in 2021. And it's not just corporate buybacks, we're talking about leveraged corporate buybacks. And I know I'm really expanding upon this short question that you asked me.
I love it.
But a leveraged corporate buyback is when a corporation looks at their balance sheet and they say, okay, we have this machinery, this real estate, we have all these assets. And the values of everything skyrocketed in 2021. So corporations went to banks and said, look, we have an extra $100 billion worth of equity just sitting there. Like, imagine your home price going up. And now you go to the bank and you do a cash out refi and you pull out as much cash as possible. Well, that's what corporations did essentially. They did a cash out refi against the value of their balance sheets, and they pulled out all this debt. Now the question is, what do you do with that debt? Do you take that cash and do you invest it in more growth, machinery, and innovation? Well, yeah, some corporations did that, but you also saw the largest number of share buybacks ever in 2021. And so they take this cash and then they use it to buy back their own stock, which makes the shareholders rich. And there's a time and place for that. But now these corporations have huge amounts of debt on their balance sheet. Now, there's a difference between the cash out refi that you can do and the corporate debt that the corporations take, because hopefully when you do a cash out refi, you're at least doing a 30-year fixed rate mortgage. Now, I wouldn't recommend taking out the cash and just buying a boat. I mean, if you're going to do it, just understand the risks. And if you're going to do it, invest, right? Get something that's going to produce cash flow. But now imagine all these corporations taking out this cash and then buying a big vacation, which is essentially what you do when you just give it to the shareholders and not investing in the company. But now they have all this debt, and it's not a 30-year fixed rate mortgage. These debts have short terms, which means that interest rates readjust after a certain number of years, sometimes 6 months, sometimes 1 year, sometimes 3 years, something like that. And so everyone is a little bit different, but they're short-term readjustments. Well, now if you borrow this debt at 2.5%, and then it readjusts at 7 to 8%, well, your payments on that debt are going to skyrocket. And this is a big concern for corporations coming into 2023 and 2024 who have all this debt, because now your shareholders are going to say, well, share prices are higher because you bought back the stock. So we need higher earnings, meaning we want to see higher revenues. We want to see higher profits. Well, if shareholders are going to want to see the higher earnings, but your expenses are significantly higher because now you're paying so much more money to pay off your debt, then what does that mean? Well, you're going to have less money to invest in growth while our economy is slowing. People have less and less ability to spend. So you can start to see all the different factors tying together. And then, of course, we have the national debt issue where our government has $31 trillion worth of national debt. This, again, is not a fixed rate 30-year mortgage. These are many times 5 years and under terms. And so our Treasury Secretary, Janet Yellen, I think this was 2020 or 2021, she was talking about how you don't need to worry about our national debt levels because our interest rate is so low. Look at the cost of servicing the debt. Don't look at the actual amount of debt. Well, here we are today, and the cost of servicing the debt is significantly higher than where it has been in the last decade. And our amount of debt is higher than anything we've seen in the last decade. And I mean, if you want to just look a few years prior to Janet Yellen's statement in 2020 or 2021, when she was the Federal Reserve chairperson in, I think this was 2017, she came out and she's, you can Google this, and she was talking about how the 20-some trillion dollars worth of national debt that we have so 20 some, this is like $10 trillion less than what we have now, should keep you up at night. That it should keep investors from sleeping because of how much national debt we have. Here we are today with national debt significantly higher and interest rates significantly higher.
Yeah, and we've done a video recently. We'll drop a link on that astronomical credit card debt. I mean, it's just skyrocketing right now. And anytime you're using a T as in trillions in front of something, obviously that's a big number. You touched on Yellen. You know, I think she's just lost tremendous credibility over the last couple of years. And we'll find it and we'll drop a link to the last video we were on here. We had you on, I believe it was summer of 2021. And we were talking about exactly this. We were talking about the transitory and, you know, the sky's not falling and they weren't making any moves at the time, you know, so I'd full on point the finger at Yellen. I'd full on point the finger at the Fed Reserve and Jerome Powell, because from a political standpoint, they were just trying to really just sweep this under the rug. They were not making any hikes. And now it's like every other week, it's a 75 BP hike, 100 BP hike here and there. So, I mean, they're absolutely crushing the economy and cooling it off by design. Too bad they didn't start doing this when they should have, because it would have more tapered off as opposed to just hitting this brick wall like it feels like we're hitting right now. Any thoughts on that? We shared the same thoughts then. Why aren't they doing anything right now? And then here we are, you know, a year plus later, and we're getting these massive, massive hikes.
Yeah, you know, a lot of opinions here, and it really frustrates me because, you know, I try to keep my channel as unbiased as possible because I want to make it educational. And this is where it gets really difficult, because I remember in 2020, I think that's the first time I posted something really where I said my opinions. And I was like, this was when the Federal Reserve Bank first announced unlimited bond buying, so unlimited stimulus, but then they also announced corporate bond buybacks. And essentially what that means for definition is, if you're a corporation, big corporation, bonds are loans. If you need money, well, now you can issue out a bond and you can get a loan from the government. Well, the Federal Reserve Bank has been known to do bond buybacks in times of distress. Like they bought treasury bonds in 2008. They did that in 2020. But then for the first time ever in 2020, they started buying corporate bonds, meaning they started lending money directly to corporations, and they're not supposed to do that. And this is where it starts to get really dicey, because wait, how do you, the Federal Reserve Bank, decide who to lend this money to? And that's when it started to get really kind of dicey, where this is not what you're supposed to be doing. Well, at the same time, you had every single person saying that this money printing, unlimited quantitative easing, is not going to cause any inflation. And of course, you know, somebody who understands the basics of money will tell you, well, if you print more money without producing more wealth, the inevitable result is inflation. And in 2021, we talked about this, right? That this is when nobody said inflation was an issue. Inflation's transitory. Well, how is it transitory? The thing that I kept saying is that the Federal Reserve Bank have fairy dust to make the inflation go away.
and so sell me some. I'll take some.
And you know, they're made up of supposedly, I mean, these are the smartest and most educated economists in the world saying that inflation is transitory, that is, it's not going to be around. And yet here you are, you have regular people, random people on YouTube saying, wait, how does this make any sense? And, you know, it's just, are they lying to us, or are they really just ignorant? And
I don't know which one of those I really want to believe, honestly.
Exactly.
You know?
And that's exactly where it leads to, where, you know, I think we all want to believe that they all have the best interest in their minds. But, you know, at some point it's like, how can you say that printing trillions and trillions of dollars is not going to cause any inflation? And then in 2021, you say it's transitory, that it's going to be gone by 2022. And now in 2022, you're saying that it's going to be gone without causing much pain to the economy. Well,
the Inflation Acceleration Act, or I mean, Reduction Act that was just signed, that's certainly going to help out, it appears, right?
The more money you spend, right? Let's spend money to get inflation to go away. I mean, look, it's like, you know, I get some people, we have good intentions, but sometimes the good intentions end up having bad consequences for the people you are intending to benefit. And this is why, for regular people, the best thing to do is not to rely on the Fed to take care of you, not to rely on the government to take care of you, but to be financially educated and understand how you can take smart decisions, how you can make smart decisions with your money. That way you can be a smarter investor and take better care of yourself, because the reality is, this is the world. Inflation disproportionately benefits the wealthy and the financially educated, and it disproportionately hurts the middle class, the poor, and the financially uneducated. So
let's talk about that for a second, because that's a super astute point. Because when, you know, in a lot of my networking circles, and a lot of yours as well, I mean, you know, inflation, albeit it's on everyone's radar, my lifestyle is not changing because inflation is rising. You know, I'm assuming that you can say the same for a lot of your conversations as well. So, you know, in that same vein, we know who it can be really, really bad for. You hit the nail on the head right there, the uneducated and, you know, folks that, you know, are really paycheck to paycheck. Who is it good for, and how? If you could dissect that, because that's an interesting point you made there.
So let's explain it this way. When the government, or anyone, let's say the government, sends out a $2,000 stimulus check to everybody, minus, let's just say, the wealthiest 10% of people. If the bottom 90% of people get a $2,000 or $200,000 check, what happens? Well, what we saw happen was some people use this money to pay down debt. Some people use this money to invest. But most people, the majority of people, use this money to spend. Now, where was this money going? Well, some people went to Walmart, Kroger, Target to buy their necessities. Some people went to Amazon, Lululemon. Some people went to Gucci and Louis Vuitton. And, you know, interestingly, Louis Vuitton, which is obviously, you know, a luxury brand, in 2021, we were in a recession, yet they were making record sales. Something doesn't add up when that happens. I mean, I remember in 2021, I was living in Chicago for a little while, and we lived pretty close to Michigan Avenue. Beautiful city. I love Chicago. And Michigan Avenue is where all the high-end stores are. And I remember walking down these streets in the middle of a day on a Tuesday or Wednesday with my wife, and I'm like, there's a 2-hour line to get into Gucci. There's an hour-and-a-half line to get into so many of these luxury stores in the middle of a day. And it just didn't make sense. Well, what we're seeing is a lot of people use this money to spend. Okay, so now let's think about that. More money is printed. So now you have more dollars in the world. These dollars are sent out to regular people. In the short term, regular people feel richer. You got an extra couple $1,000s. Now you take this couple $1,000. Now some people, I'm going to say this again, some people who are financially educated did smart things with this money. But you had a lot of people who took this money and they spent it on things they didn't need. This is, you know, when they call it a stimulus check, what does that mean? Are you trying to stimulate your individual wealth? No, it's a stimulus check for the economy. They want you to go out and spend it. So now when you go to Walmart, or you go to Amazon, or you go to Lululemon, or you go to Gucci and you spend this money, where does that money go? Well, now you go and spend this money and you get a thing. This thing is disposable. It's going to be worth $0. It could be food. It could be clothes. It could be electronics. It could be anything. You buy this thing, which is now worth nothing. And now the corporation, the company, gets the money that you spent. And now, again, there's a bigger amount of dollars out there. And now these dollars have just flown to the wealthy, because now it goes to Walmart, Lululemon, Amazon, Apple. And now they control a bigger share of the dollars, because now there's less dollars out there, meaning if you had $1,000 in the bank before and after, you own a smaller percentage of the wealth. But now who does it benefit? Benefits the shareholders, the owners of the companies. Now, the nice thing is you don't need to be a billionaire to own a piece of Walmart or to own a piece of these corporations. You can start investing in corporations with as little as $1. And some people did that. Some people began investing in 2020 and 2021. And you saw the gains. You saw the stock prices of these companies soar in 2020 and 2021. Why? Because more people were shopping there, more people were buying more things there, and these companies saw bigger revenues and bigger profits. And so who does it benefit? It benefits the people who own the means of production. And who does that? It's not just rich people. It's not just multimillionaires. It's people who are financially educated. Now, sure, if you have $10 million to invest versus $100 to invest, the amount of dollars you're going to see in a return is bigger on the $10 million, but everybody starts somewhere. And it's better to start with $100 than to not start at all. And this is why it benefits the financially educated. And now, of course, we're going through a correction and slowdown in everything right now. However, again, it's just pieces. There's different pieces of financial education for different pieces of the economy, and understanding how to use your money, how to be a long-term investor, because what we've seen over the long term is long-term investors make the most money over the long term, and it's not the traders.
As an investor, what are your predictions for 2023? As an investor, I actually don't mind higher mortgage rates, because that thins out the herd. There's going to be less investors out there that are competing for the same deals that I'm looking at. I'm from the philosophy, look, if there's meat on the bone as it stands today, knowing that the ultimate goal, when rates do drop in the next year or two, or whenever that's going to be, to do a refinance, obviously 100% of that refi is going to convert to my net bottom line cash flow position. That being said, there's a lot of investors that are just sitting on the sidelines thinking, well, I'm going to wait for interest rates to drop a point or two over the next couple of years, but at the same time, property appreciation might be going up 5% on that same property. How do you balance that, and what are your predictions as an investor?
Well, as an investor, I don't try to time the economy. From real estate, I look for a 7% cash on cash return. That means if I can see the return that I like, I'm not going to sit here and change my decision based off of what's happening with interest rates, what's happening with the economy, because I want to make sure I have enough buffer based off of what's happening. Now, of course, I'm going to be paying attention to it. Higher interest rates cause asset prices to go down. They push asset prices lower. So in 2023, when you ask my prediction, it's going to ultimately go down to what the Federal Reserve Bank does. But I anticipate, again, this is my opinion, I could be wrong. I anticipate pain in the economy. I anticipate pain in asset classes. And I don't think it's going to be just a 2023 thing. I think it's going to continue on. And sometimes you see a deviation between assets and the economy. Now, you can see the stock market go up when the economy is going down, and you can see the economy go up and the stock market go down. So you can see a deviation between assets and the economy. I think that there's going to be economic pain ahead. To what extent? Well, that's going to depend on what the Federal Reserve Bank does. And unlike previous times, we don't have the same capacity to stimulate and do quantitative easing like before, because before the 2008 crash, before the 2020 pandemic, before the 2001 dot-com burst, we weren't worried about inflation. And so when the Fed did quantitative easing after each one of these economic slowdowns, well, it was okay because we didn't have an inflation issue. Well, now, if we see an economic slowdown, the Fed also has to contend with an inflation crisis. And so that could potentially, again, I don't want to speak for what the Fed will do, because sometimes they do things that no one expects, but it could make them stimulating and cutting interest rates a lot more difficult.
Guys, we're here with Jaspreet Singh. He's a content creator on a phenomenal YouTube channel called Minority Mindset. If you guys have not checked it out, we'll go ahead and drop that link below. Like-minded folks on his channel as well, guys. We always love having him here on as a guest. So in that same vein, you're seeing and you're predicting a lot of pain. What do you think the biggest problem or biggest obstacle we're going to face in 2023 is going to be?
Well, the debt crisis is going to be the biggest thing.
It's here, yeah.
I mean, we're talking about it's an everything debt crisis, because you have consumers with the highest amount of household debt ever. We have corporations with the highest amount of corporate debt ever. And we have the national debt at the highest levels ever. These are facts. You can Google them. And now we are seeing interest rates rise at the fastest rates ever. So, I mean, just think about that. If you have the most amount of debt ever, while the cost of servicing the debt is growing at the fastest rate ever, that means expenses are going to go up. Well, if expenses go up, that means people have less ability to spend, and not just people, that's people, corporations, and the government. And our economy runs on spending. So if all these entities have less ability to spend when our economy runs on spending, what that tells me is there's going to be a reduction in spending in the future, because all these entities are going to have to spend more to service their debt. less money to spend. And if each one of these entities have less money to spend, well, that causes an economic slowdown. And generally, when you have an economic slowdown, the Federal Reserve Bank can stimulate. They can inflate the economy, they can cut interest rates to inflate the economy, and they can send out stimulus checks. Well, it's not so easy this time because we're also facing the high inflation. So again, I can be wrong, but based off of that analysis, I mean, it just seems like there's a lot of red flags. And what that means to me is I want to be prepared. Prepared just not just so I can survive, but so I can thrive. Because like what we discussed before is recessions create more millionaires than any other time. Well, in order for that to happen, you have to not only be able to eat, but you have to have cash to take advantage of opportunities that come your way. And so what does that mean? That means spending less now, having more cash, having more ability to invest. That way you have that capital. Because, you know, let's just say I'm wrong and you prepare. Well, if I'm wrong and you prepare, you have some extra cash, go to Disney World. But let's just say I'm right and you don't prepare. Well, now, if you run into an economic hardship, you lose your job and you're not prepared. Now, not only are you not going to be able to take advantage of opportunities, but you're going to struggle being able to pay your bills. And so it's weighing the lesser of two evils, where these are the red flags. Okay, what are these red flags going to amount to? I gave my opinion. I think we're going to see pain. I could be wrong, but whether or not I'm wrong, why take that risk? Why not just protect yourself and be aware and put in the precautions in place today that way you can survive, but also thrive through a potential economic slowdown.
Yeah, I love that. And we always talk about that on our channel as well. Guys, there's nothing wrong with being prepared. Guess what? If it doesn't come, if that time doesn't come, you're still prepared for if and when it does come. So that exercise is never made in vain. Absolutely. So those are some of the things to be watching out for in 2023. Those are some of the red flags. Let's talk about some of the massive opportunities. Let's end this video on just a really high note. So how do you win? How do you ride the bottom? You know, if this is in fact the bottom right now, how as an investor do you take a look at maybe some short-term pains in order to achieve long-term wealth? And it's that mindset right there that's going to separate people right now from the people that are, you know, going to be getting this generational wealth possibly during this time versus the ones that are sitting on the sidelines wishing 2 years from now they would have been making moves.
Sure. So, I mean, I think the best thing that I can do is just talk about what I do and what I've done, rather than telling people what to do, because advice can be very risky. And I want to make sure that the best thing is for you to be financially educated. So I got into real estate investing on accident, very fortunately, after the 2008 crash, when real estate prices at dirt bottom. And so I was able to buy a lot of real estate at a very discounted price. And I didn't realize that I was getting such great deals. Now I can see it, but I was able to buy deals sometimes 90% off, sometimes 92% off of their previous sales price. And now the same real estate that I bought then is still producing cash flow, higher cash flow today than before. And they're worth many multiples now than what they were before. So it's finding the opportunity, meaning assets that are hit hard, because you're going to see two things happen when you see a recession. You see bad assets get hit hard, and then you see good assets get hit because bad assets are getting hit. When the bad assets get hit, they may never recover and they might go into bankruptcy. When the good assets get hit, that creates opportunity because now you can come in and buy a great investment at a discounted price. Now, where are those investments? Well, they can be really anywhere. There's a book by Sam Zell. Oh, what is the name of his book? There's only one book. Read his book. I would highly recommend it because he talks about how he found opportunities in so many different recessions and just some of the most bizarre and opportunities that you wouldn't imagine, because most of the times you're thinking about stocks and real estate. Well, he took that a whole nother step further. He was a real estate investor, but found opportunities in so many different industries. And he talks about how it's just for him looking for wherever the opportunity is. And so it's looking wherever the opportunity is, meaning wherever you see good assets get hit, but then also something that you're willing to put in the work for. Because if you're not willing to do the research and research a company or research a real estate investment or whatever, Don't throw your money into it just because you think it's a great investment. In that case, use more of like passive investments. There's ETFs and index funds that you can look into that will give you broader exposure, that will lower your risk. Yeah, it's going to lower your upside, but it also lowers your risk because you don't want to just blindly throw your money, because the reality is when you go through these downswings, things will go bust. You're never guaranteed to make money when you invest. You might even lose money, which is why you should never blindly listen to a random guy on YouTube. But this is where, just being financially educated. And, for me now, I have my passive investments going. I'm less actively investing in stocks and real estate now, not just because of the economy, but because I'm investing way more actively into my own businesses. I see a lot of opportunity there. And, that doesn't mean I won't buy real estate or stocks or whatever. I just look for opportunities kind of wherever they are. Right now, I see a lot of opportunity in my businesses.
Yeah, I love that. We'd like to reinvest in our businesses as well. I've got multiples, and I'm out there in other investment classes as well, but there's nothing better than dumping the money back into your own business. It's kind of your own baby. So I can certainly that certainly resonates with me. So you talk on your channel a lot. We talk on our channel a lot about leverage. Let's dive into that real quick. What does leverage mean to you, and why is it more important now than ever?
Well, the traditional term leverage, I would say, is just debt. And now leverage is important because you have a lot of people who are very over leveraged, and crashes happen when you see a correction plus a lot of leverage. Meaning, think of just 2008. Why did we see such a big real estate crash? Because people were so over leveraged on properties they couldn't afford. And so when property prices fall by 15 to 20%, and now people had 2% down payments or 0% down payments, and now you're completely underwater, you don't have any incentive to keep paying. And so if you have no incentive to keep paying, well, now you might just mail in the keys. And that's what then turned the correction into a crash. And so you see that type of leverage issue there, which is where, if you're starting off, do not use any leverage, especially if you're not, just learn the ropes before you start borrowing money and doing that, because that just makes everything so much more risky. But besides that, leverage is honestly levering education, I would say. Lever whoever you can get access to, use YouTube, use books, use classes, use consultants, leverage education, leverage other people's minds, because the best investment that you can make is in yourself.
Yeah, I absolutely love that. We always encourage people to, obviously, what we bring to the channel is going to be a wide variety of our own opinions and other folks like yours. But obviously, everyone go out there and do their own due diligence, particularly if you're new in the space as an investor. You can really make one bad move out of the gate on your first investment and completely kill, any potential future investments for yourself. So particularly out of the gate, surround yourself by mentors, people that you trust. Don't just take our word for it, because we're on YouTube, of course. But guys, we are bringing a lot of information. We're bringing who we deem to be experts on the channel. That's why we've got Jaspreet. If you guys are not familiar with his channel, go ahead and check it out. We'll drop the link to Minority Mindset. Jaspreet, thanks for joining us again today. If you've got any parting words, our folks would love to hear it.
Well, thank you for having me on. The last thing is, the most important thing is to be educated. Don't just blindly follow what somebody else is doing. Make smart decisions for yourself and really embrace the idea of the minority mindset. If you see everybody doing one thing, well, then you might want to take a step back and see why they're doing it and see if it's right for you.
I love it. Guys, check his channel out. Thanks for joining us on the video today. Go ahead and hit that thumbs up. If you're not a subscriber, go ahead and subscribe and ding that bell notification. Until next time, make it a great day and take care.
Thank you for having me on.